Hello, everyone. So, we are back for another weekly recap, and what a week it has been. I feel like I say that every single time, but each week just kind of outdoes the last, crazy enough. So, of course, the biggest revelation this week is the ongoing war overseas between Iran and Israel. And of course, we're not really sure where the US stands right now. So, there's so much uncertainty. And so, what you will see in times of uncertainty is the stock market will be rather volatile. And we definitely saw that this week. The stock market definitely took a hit. And one thing I will say, our hearts and prayers are going out to all parties involved in this war. Definitely not here to pick sides, but this is definitely a scary time, especially since there have been threats against the US if we end up taking action. So, definitely a very intense time for us all to be in right now. So, putting that to the side, you will see also during times of war that the companies that provide products and services, they tend to do really well, obviously, in times of war. So, if you are not currently investing in those industries, something you may want to consider, of course, you want to make sure that you are following your own ethical guidelines, your investor checklist before you do that, but this is the part of using real world news and information to help you make investing decisions. And this is one thing I think many people just don't consider. We tend to gravitate to the same industries that we're just most comfortable with. So whether it's retail, whether it's tech, whether it's travel. And so there are so many industries outside of the mainstream ones. So you really do need to start thinking a little bit more broadly when it comes to investing. And you want to look at where are your blind spots, right? You know where you are invested, where are you not investing? And there are so many ways you could take that, but this is where we talk about diversification, right? So you have ways to diversify, whether it's investing in different asset classes, or within an asset class, you can invest in different types of things. So, something to consider as you navigate your investing journey. But one thing I will say, during times of uncertainty, people tend to gravitate towards things like gold and now things like crypto. And so I want to share my screen to show all of you what's been going on in both the gold and crypto market. Let's see, is this the screen I want to share? It is. Let me just make sure you guys can see my screen. So this screen is showing the price of Bitcoin. We can see the performance in the last day, 5 days, 1 month, 6 month, year to date, etc. And as you can see, if we do this 1 year trend, right around November, which is when we had the election here in the US, you see the crypto market started to really take off. And then coming into the new year, we saw this downward trend. And the downward trend kind of definitely coincides with the volatility of the overall stock market. We have this ongoing conversation around tariffs, and all of that is impacting all segments of the market, including crypto. And where we're still in this weird place, and the crypto market is starting to rebound. It's like 108,000 per coin, which is even crazy to say. I first started really paying attention to it was, of course, in 2020. Like most people during the pandemic, Bitcoin was like $6,000 per coin. And then when it jumped to like 13,000 per coin, it was like, whoa, this thing really doubled pretty quickly. And now we are a long, long way from $13,000 per coin. And so it's definitely been a wild thing to see. But this is where we talk about expanding your horizon when it comes to investing. I know once upon a time, crypto definitely felt like it was this weird thing. It felt imaginary. It's not real. Maybe it's a scam. We're not really sure. But over the years, crypto is starting to gain a lot of traction and starting to kind of have teeth, right, in the game. And I will say that now that Coinbase is part of the S&P 500, that right there was a major milestone, just further solidifying crypto as a serious asset. And so if you have a 401k, an IRA, a pension, and it has any kind of index fund or mutual fund that mimics the S&P 500, you are investing in crypto indirectly, but you are. So crypto is here to stay, something that more people will take more seriously as it gains more traction, but definitely something to see. But getting back to my point, so during times of uncertainty, people tend to, well, investors try to find places where it's a safe landing for them. There's more stability. Now, Bitcoin definitely isn't stable, but that's more so something like gold. So, gold is that asset that many investors gravitate to when there's so much uncertainty and we're not sure what's going on. It's a relatively safe asset. You know that if you do buy gold, whether it's a gold coin, a gold bar, gold jewelry, what have you, it has value. It has intrinsic value wherever you are in the country and wherever you are in the world. You can easily sell it for cash if you so need it. So it's rather liquid asset. And that's why investors love to invest in gold when the stock market isn't doing so well. So I'm going to stop sharing my screen to another graph I want to share, where this is where you will see what gold has been doing lately. And so gold is definitely also, it's not at an all-time high, but it's pretty close. It's well over $3,300 per ounce. If we go back to a year ago, it was at $2,300 per ounce. And you just see the trend, it's just growing in value, it's increasing in value. If I kind of go back here, if I do 6 months, is that a better view? So it's not a straight up trend, but you see there's some dips here. But overall, gold's been growing steadily but surely, and other commodities as well. Think about silver, platinum, etc. And if you are not currently investing in gold, something you should seriously consider. Now, there are multiple ways you can invest in gold, whether you buy the commodity itself or if you invest in companies that are in that industry, the ones that mine and sell gold. Definitely another way to invest in gold, since it is kind of expensive trying to buy ounces. You can, get into the market in other ways. But whole premise of this is we have a lot more uncertainty ahead between the administration here in the US, the war overseas, and we don't know how that's going to play out. You will see more and more investors gravitating to things like gold, silver, and also crypto. Now, crypto isn't stable necessarily, but it's an alternative investment, and that's where investors are flocking to, since the stock market definitely doesn't feel safe for many people. So, just a little sidebar for today's conversation. Next big news this week, the Federal Reserve did decide to hold interest rates. And truthfully, no one's surprised by that, right? There's so much, again, uncertainty around tariffs and the war. For them to change interest rates right now is definitely too soon for them to do that. And Powell definitely did make that super clear even before the Israel-Iran war became a thing. For him, it was the tariffs. We don't have a set plan with tariffs. We are in this kind of trade war with countries all across the globe. And because of that, it doesn't make sense to make any changes. They're kind of doing this wait and see approach. Now, if you're wondering, well, why do they care so much? Well, interest rates definitely impact so many components of the economy. So when the Federal Reserve sets interest rates, everything else kind of stacks on top of that. So the interest rates in which you can use to buy a mortgage, to buy a house, credit cards, interbusiness lending. And so what they will do is if they're trying to slow down spending because inflation is high, they will increase interest rates to kind of slow things down. When the rates are higher, less people are willing to borrow money, less people are looking to finance. So that means less purchases are being made because unfortunately we are a credit based country. And then the opposite holds true as well. When they are looking to stimulate the economy, they want to encourage people to buy and borrow money, they will reduce interest rates. But unfortunately, with COVID, it kind of didn't follow the normal economic trend that we've seen in the past. So we definitely had inflation happening during COVID. We also had a lot of uncertainty during COVID. So they started to slowly increase interest rates, ideally to slow down spending because there was lots of disposable income because people now were having major lifestyle changes. They were relocating from high cost areas to low cost areas while keeping their high incomes. They were working from home and weren't incurring certain expenses. So all of that disposable income was flooding the market. And so they began to increase interest rates to slow down the spending. But unbeknownst to them, that didn't happen. People kept spending, they kept borrowing money, they were buying houses, they were buying cars. And so we kind of had a double-edged sword. We had inflation going up, and then the spending just kept happening. And so now we're in this place where we've kind of hit that wall where inflation is getting pretty high. Spending is definitely slowing down on both the consumer side and the business side. And so when people aren't spending money, companies aren't making money. When they're not making money, they have to cut costs to hold their profitability. When they're cutting costs, they're laying off people. When people are laid off, they don't have money to spend. So it's this like vicious cycle that kind of just keeps going round and round and round. And that is where interest rates come into play. They use the interest rates to either encourage spending or to discourage spending. And right now, they're just holding steady because we don't know where things are going right now. So that's my little mini lesson for the day. So next major news for today is the infamous TikTok ban. Yes, it's like we're literally kicking the can down the road. So the ban was set to go into effect, I want to say June 19th, which was yesterday. But President Trump did extend the pause on the ban for an additional 90 days. So now TikTok has until September 17th to sell the US portion of TikTok to a United States based company. Now, at this point, it's becoming mentally exhausting because nothing is really happening. There's no negotiations happening. ByteDance, who is the parent company of TikTok, they don't want to sell. They haven't really spoken of selling truthfully. They've just made minor comments here and there, but I really doubt they will sell the US component of TikTok. And so once September comes around, we may just be in the same place once again. Now, what I will say, as someone who uses the platform not only as a creator, but also as a consumer, the app has not been the same since the blackout that happened back in January. The vibe is definitely a lot different. But nonetheless, TikTok is definitely a major economic powerhouse. I would find it very hard to believe that they are willing to totally shut down the US part of the app because so many people rely on that app to make money. And not just creators, because of course there are many creators on that app that generate revenue for themselves and income for themselves from the app, but you have small businesses, large businesses, they are all on that platform between selling items on TikTok Shop, running ads to promote their products and services. Even Amazon has this integration with TikTok where if you see an ad for an Amazon product, you click on that link, it keeps you like right in the app and you can make your purchase and then you go back to scrolling on the app. So many hands in this pot, too much money being made on that platform for it to just go away magically. And truth be told, there's no other app like it. Like Instagram could never. Now, mind you, I love Instagram. I use Instagram both as a creator and as a consumer, but Instagram could never compete the way with TikTok and the way that app operates. So for it to go away, I don't see it happening. I wouldn't be surprised if they just continue to extend this postponement for like perpetuity, or I don't know. That's what I see happening. I don't see ByteDance selling. I don't see the US banning the app 100%. So we'll just be in this purgatory area, in this purgatory space for who knows how long. So that was the major news that happened in regards to TikTok this week. Other big news, Trump Mobile. What do you guys think about that? Very, very interesting. So the Trump organization has announced a new cell phone service called Trump Mobile, where you will pay $47.45. Yes, that is a play on the presidency. And for that amount, you receive unlimited text, talk, and data. You receive cell phone protection, roadside assistance, and free international calls to over 100 countries across the globe, including US military bases. Now, you can bring your own device, or you can buy the fancy schmancy T1 phone for, I think, almost like $500 currently. It's not available. It will be available in September, but they do require a $100 down payment to pre-order the phone. So many things I want to say on that, but I think I'll keep it rather simple. I think a lot of people are very distrusting of the organization to be their cell phone provider. So I'm not sure how well it's going to do. But he also has a lot of supporters that may full-fledged leave their current providers and jump ship. So who knows? Supposedly, there is no way to sign up online. You have to call into a call center to sign up. It is 24 hours a day, 7 days a week. I don't know if they're US based, though. That's the question that everyone's asking. I have not been able to find that out. But if they're not US based, then it's kind of like, well, that feels a bit contradictory. Speaking of contradictory, this T1 phone is not made here in the US. It's currently made overseas. The reason why I find that funny is Trump has been harping on Apple and Samsung to bring their operations from overseas to the US. And if they don't, he's going to charge major tariffs on their products. So it's funny to see that you're having this angle with Apple and Samsung, but for your own product, you're not keeping that same guideline. Like, you're having the same issue. You're making it overseas because it's cheaper, and at some point in the future, it will be brought and will be made in the US. Pretty interesting. So, big headline this week, I think that came out like on Tuesday or Wednesday. And other major news, Chase and American Express, they are definitely trending right now, and not in a good way. So they're making major changes to their top tier credit cards. So Chase has the Sapphire Reserve, American Express has the Platinum card, which both are their top tier travel credit cards. And so they are significantly increasing the annual fees. Now, in correspondence with that, they are also adding additional benefits. But truth be told, the increase for Chase is like almost 45%. It's something astronomical. It's going from $550 per year to $795. That is wild to even say. Also, for authorized users, that fee is increasing from $75 to $195. Seems pretty wild. Now, of course, their spin is that with the increase, you are going to get even more value from the card. So in case you're wondering, they're adding a subscription to both Apple TV and Apple Music. You will receive additional credits to like DoorDash, StubHub. What's another one? Yeah, StubHub and DoorDash. You will be earning more points on certain categories. And also, your point, they're changing the redemption value of points on the Chase travel portal. So essentially, the points that you earn will now be worth double what they are worth today. Now, for Chase, the change in the annual fee for new credit card holders will go into effect on June 23rd of this year. Now, if you currently already have the Chase Sapphire Reserve, this annual fee change will go into effect on October 25th, well, after October 25th. So if your renewal is happening between now and October 24th, you'll have one additional year of the lower annual fee. But if your renewal is happening after October 25th, as soon as that renewal kicks in, you will be paying the higher annual fee. Now, of course, there's lots of discord online. People are not happy about the change. I think we all anticipate increases when it comes to the credit card annual fees over time. I recall when I first got the platinum card, the annual fee was $395. That feels like forever ago at this point. And you know that over time it's going to slowly increase, but to jump from 550 to almost $800 definitely seemed excessive. And so there's definitely going to be a lot of backlash behind that. People are already discussing either canceling the reserve, downgrading from the reserve to the preferred. And yeah, so there's a lot going on with that. I think the additional value they're giving kind of, they're kind of making up for it. But I think the sticker shock is what's really keeping people, um, well, has people up in arms about all of this. It just seems inflation's already high. You're just kind of adding to the problem, right? But part of me feels they are trying to outprice people out of the luxury travel credit card space. If you think about it, luxury travel credit cards became super popular around 2017, 2018, and the demographic of that customer base changed significantly. It really in the past was, older customers who might be retired or later in their careers. So present day, it's more, you know, middle age to late age, well, middle to late millennials, even Gen X, Gen Z, excuse me, Gen Zers, right? They're now becoming the target customer for these luxury travel credit cards. And it feels like they're trying to move the goalpost and they really just want a certain kind of demographic for this credit card when it comes to earning capacity, right? And so that's just my opinion. Chase, of course, hasn't said that by any means, but I definitely feel like they're trying to shift the card and change the demographic. And also, I feel like they're doing this to reduce the crowding in the lounges. And that's been one pain point for all the credit card companies between American Express, Chase, even Capital One. Now, Capital One is relatively new in the credit card or the luxury credit card space and the airport lounge space. And they are already having crowding issues at their lounges, which is crazy. So much so, they've already announced they're making major changes to the lounge access for their credit card holders of the Venture X. And it definitely feels strategic. It feels like they're all in cahoots because these announcements all have happened within the last week or two. There's no way that wasn't done in a silo. These companies definitely are all in cahoots, and it definitely feels, I don't know, it gives me the ick, for lack of a better way to explain that. So with that being said, the only thing we don't know, which I'm kind of disappointed and we'll have to wait, is American Express kind of alluded to them making changes, but they gave no specific details, like none. They didn't say how much annual fee is changing by. They didn't say what perks and benefits they're changing. They just made an announcement, oh, we're making changes later on this year. And that was it. And what's crazy, I saw I saw a post on social media and they mentioned this whole press release that American Express put out that day. And I was so excited to read the press release and it didn't say much of anything. So I kind of feel like, well, what was the point? At least with Chase, they told you exactly what they're doing, what changes you can expect, when they're rolling the changes out. Capital One, they also were very crystal clear on the changes that they're making. And American Express is just like doing this mysterious thing where they're like, well, we're making changes later on this year. So I feel that they're trying to like read the room. So they let Chase make their announcement. Capital One made their announcement. And I feel like they're going to make tweaks to their changes based upon the feedback they see the other companies get on their changes. Now, I'm totally guessing this. I have no inside scoop whatsoever, but that's what it's giving, right? So let me know in the comments what you think about that. But I'm definitely looking to see what changes American Express rolls out. I feel like they are like the leader in the luxury travel credit card space. So whatever changes they make, the other banks kind of follow suit. So it's kind of weird that this time it's happening in reverse. The other banks have made their changes and American Express is kind of waiting to announce theirs. So we'll see. We'll see how that plays out. Next major announcement, Amazon. So Amazon, the CEO made some comments earlier this week that they are replacing jobs with generative AI. Now, that in itself isn't like surprising to anyone, but it's just kind of them saying the quiet part out loud. And this is why I've been saying this, not only from an investor perspective, but from a career perspective. We all, when I say all, we all have to start paying attention to AI and taking it a lot more seriously. Now, I'm speaking to myself when I say this. I know when AI really became more popular about a year or so ago, I was very much anti AI. I felt as if it's going to disrupt things and not in a good way. It's going to hurt people financially between jobs being replaced. So I didn't see AI as a good thing, just to be transparent. But over the last, I would say 6 to 8 months, one, I'm realizing I've been using AI, not knowing that it was AI. So there's that. And also, I'm realizing, well, it's not going anywhere, right? So you can't really fight the wave. So you kind of have, if you can't beat them, join them kind of thing. And so I'm realizing more and more that for me, AI has been a very useful tool, and I'm finding it to help me with just doing things faster, being more efficient, brainstorming ideas, so on and so forth. But when it comes to your career, you can kind of use it in the same way. So right now I'm using it more so in my personal life. I am using it in my business as well, but I'm still in the early stages of that. So if you are someone who's like anti AI, like I was, I get it. I see you, I hear you, but you don't want to find yourself pushed out of your career because you weren't willing to get on board. And then AI is just like another industrial revolution. So we know that many, many moons ago, there were definitely careers that were disrupted, jobs that just didn't exist anymore because of technology. But on the same token, new jobs were created also. And so we're going to see the same shift with AI. The only thing I will say, the shift is going to happen a lot faster. So what would have happened or would have taken 10, 15, 20 years to happen may only take 5 or less. So whatever you do for a living, I don't know who you are or what you do, AI is going to change how you work and how you show up to work. And so if you aren't willing to get ahead of that, you will get left behind. Just putting it out there. So I think we all need to kind of navigate that from a career perspective, but also as an investor. As AI becomes more popular, it becomes more mainstream, it becomes more in demand. The companies that provide the logistics, that provide the products, that provide the software, they will become in more demand as well. And so you want to really think about that as an investor. Now, if you're anti AI, you don't want to invest in I get that. But I will say keep an open mind and be fluid in your thoughts. So, When it comes to earnings calls, it was pretty quiet this week. I only really saw two companies that were worth mentioning for today's live, and they are Kroger and CarMax. So I am going to go ahead and share my screen in just a second, and we'll kind of talk briefly about Kroger's financial results, and then we'll talk about CarMax as well. So Kroger had a pretty good earnings call. They went over their Q1 results. Do I want to share the PDF? I guess we can share the PDF. You guys should be able to see this. Let me just double check. Okay, yeah. So this is the press release from Kroger's Q1 earnings call today. I'm just going to skip all the way down to their financial statement, which is here. So sales, if you look at this is Q1 of 2024, we're at about 45 million. And then you have Q1 of this year, they're also at 45.1 million. So sales are down slightly year over year, not horrible. And then if we look at their net income is down slightly. So we're at 866. So not horrible either. But the reason why Kroger had a great Q1 earnings call is they had a positive guidance for the full year results. Let me pull up their stock. Their stock was up like 9% or something like that. So let's just take a peek. There we go. So Kroger stock price is about $72 per share. If we look at it for the week, it's at about up almost 10%. And all of that, this big jump is solely due to the positive earnings call they had today. So they definitely are feeling very robust in their future sales for the year. What drove the positive sales is pharmacy sales and also produce, which is kind of interesting. Now, do they pay a dividend? They do. So if you see here, it's about $1.28 for the year. Pretty low compared to the stock price. The dividend yield is only about 2%, but they do pay a dividend nonetheless. If we look at the current stock price of $72 per share, and we look at the 52-week range, the stock is definitely on the more expensive side, but that makes sense. They had a great Q1. They've been doing relatively well the last 2 quarters in a row. So it makes sense that the stock is up and a bit more expensive right now. So nothing too crazy to talk about. They didn't mention they don't expect tariffs to have a big impact on their earnings. I don't know much about their logistics, so I was kind of surprised to hear that since produce is a big component of many grocery stores. So I'm not sure how they're navigating that, but they feel confident. Oh, they also, their earnings per share beat expectations by 2%, which is, of course, great also. So they had a pretty good earnings call. So let's, now CarMax was the other company that had their earnings call this week. And I was quite surprised at their results. So as we know, the car market, whether used or new, is not doing so hot right now, but CarMax is doing phenomenally well. And if I had made a bet before looking at their results, I would have lost the bet. The car market is not doing well. Between repossessions are high and they're increasing every month. Sales are down because people just can't afford to purchase cars, especially with the higher interest rates. So I was definitely surprised when I saw this. So just to kind of show you what we're looking at, this is their Q1 results. We're comparing 2024 to 2025. And if you see here, their revenue is up year over year, which was quite surprising. Their profit is up 13%, which is also quite shocking. And then their earnings per share is up like 42% or something crazy. Where did I see that? Let me see if I can find it here in the yeah, net earnings per share increased 42% year over year. So quickly, what is their ticker symbol? KMX. Okay, so let me go ahead and start sharing. Okay, let's see. So stock price is about $69 per share. This is up about 7%. Again, primarily due to the positive earnings call that they had earlier today. They do not pay dividends. You can see that here. The forward dividend and dividend yields all say zero. There's no ex-dividend date, anything like that. But I, again, still pretty shocked at how well they did financially. Now, the stock isn't right. It's definitely down about 4% versus last year. Oh, yeah, the stock really isn't doing well. At its height in the last 5 years, about $154 per share. So it's down like 25%, which is wow, that's pretty steep. But it also makes sense, right? The used car market has not done well since we kind of began to come out of the pandemic. And that just coincides with what you see here on the chart. The peak was about late 2021. And coming into 2022, it's just been a downward trend, kind of holding steady for the last 2 years, surprisingly. And so, yeah, they definitely had a great Q1 call. And I'm curious to see what the other car retailers are going to report in their future earnings. So, something to be mindful of because the car market is not doing so well. So, I'm not really sure what is causing them to do so well, but I have to do more digging to kind of educate myself on that. So, yeah. So, that is that. So, that's this week's weekly recap, everyone. I hope you found this very useful. I know that for these videos, I get more views on the replay. So if you are watching the replay, definitely feel free to leave a comment down below. You can also leave any questions you might have on anything that we discussed in today's live. We are going to resume these lives each week. I had to take a break. It's just been a lot going on behind the scenes, but we are going to resume these lives every Friday at 8 p.m. Eastern. So I look forward to seeing you guys next week. Take care.